The numbers just came in from the CME Group, and the silver market, as we knew it, is officially gone. While the mainstream was looking the other way, silver futures just ripped through the $80 psychological barrier, hitting a high of $83.97. This isn't just a daily fluctuation or a bit of noise on a chart. This is the CME itself confirming that the breakout everyone said was impossible is now a reality. But here's the part that should make you pay very close attention. Usually, when the price of an asset rockets up this fast, you expect to see the vaults being drained to zero. Yet, the latest data from the LBMA in London shows that silver stocks actually grew by over 2% last month. Wait, think about that for a second. If the price is exploding, why is the physical metal flowing into the professional vaults instead of out of them? It suggests that the big players are no longer just trading paper. They are hoarding the real thing at any cost. We are seeing a complete decoupling of the old pricing models, and for the first time in years, the data suggests the Western markets are scrambling to catch up to a reality that China already accepted weeks ago. Before we dive into the staggering numbers coming out of Shanghai, we need to ground this in the mechanics of how the silver market actually functions. You'll often hear people talk about the vaults being empty, but when we look at the CME's reporting, they distinguish between two types of silver, registered and eligible. Registered silver is the metal that is sitting there, tagged, and ready to be delivered to a buyer who stands for their contract. Eligible silver is just metal being stored in the warehouse. The owner has no immediate intention of selling it. When you see the registered numbers drop while the price moves toward $83, it tells you the liquidity is drying up. But there is a second term you need to know right now: backwardation. Typically, silver is cheaper today than it is promised to be 6 months from now. That's normal. But right now, we are seeing signs that the spot price is fighting to stay above the future price. This is the market's way of screaming that it needs the physical metal right now, not next month. It's a signal that the paper promises are no longer enough to satisfy the demand of the industrial giants and sovereign buyers who are looking at the same data sets we are. Let's look at the proof. According to the Shanghai Gold Exchange, the silver benchmark price just hit $2,607 per kilogram. That is a nearly 10% jump in a single day. In the West, we're celebrating an $80 handle, but in the East, they are already pricing silver as if the shortage is an absolute certainty. This is the Shanghai Premium in action, and it acts like a giant vacuum, pulling physical silver out of New York and London and into Chinese industrial hubs. Now, let's check the London vaults. The LBMA reported a 2.3% increase in silver holdings, bringing the total to over 27,000 tons. Stop and look at that number again. Here is what that does not mean. It does not mean the shortage is over. In fact, it often means the opposite. Bullion banks aren't selling into this rally. They are accumulating. They are preparing for a much larger move. Then we have the USGS. In a move that almost no one in the retail space noticed, the U.S. Geological Survey officially added silver to the critical minerals list for 2026. This is a massive policy shift. It means the government now views silver as essential for national security and the energy transition, alongside lithium and cobalt. But here's the second thing this data does not mean. It does not mean the COMEX is going to default tomorrow. A default is a specific legal event. What the data actually shows is a managed retreat. The COMEX is losing its status as the world's primary price discovery mechanism. While New York traders shuffle paper contracts, the real power is shifting to where the metal is actually being consumed and stockpiled. To understand why $83 is just the beginning, we have to look at the plumbing of the market, specifically the short squeeze dynamics hidden in the CFTC's Commitment of Traders report. Right now, the data shows that the major banks and managed money funds are in a precarious position. For years, they've used paper contracts to keep a lid on the price, but that game only works as long as nobody asks for the physical metal. Think of the silver market like a crowded theater with only one tiny exit door. For years, everyone has been content to sit in their seats, trading tickets back and forth. But now, the USGS just shouted fire by labeling silver a critical mineral, and the Shanghai price is the smoke billowing under the door. The shorts, those betting the price would go down, are all rushing for that one small exit at the same time. This is what we call short covering. The latest CFTC data confirms that shorts are being closed out at a record pace. When a short seller closes a position, they have to buy silver to do it. That creates a massive self-reinforcing loop where the act of escaping the trade actually pushes the price higher for everyone else still trapped inside. It's important to realize that this current rally isn't even being driven by a wave of new retail buyers yet. The data shows managed money longs have actually decreased slightly. That means the smart money is still sitting on the sidelines or waiting for a pullback. This entire move to $83 has been fueled almost entirely by the people who were wrong about the market scrambling to save themselves. If the shorts are this panicked now, imagine what happens when the actual buying spree begins. So, what does this actually mean for your portfolio over the next 72 hours? Based on the data, we are looking at 3 distinct scenarios. In the bull case, if the Shanghai premium continues to widen and the shorts continue to liquidate, we could see a technical test of $90 an ounce much sooner than anyone anticipated. The breakout at $83 wasn't just a peak, it was a floor. If the CME reports another drop in registered stocks tomorrow, the momentum could become unstoppable. However, we have to look at the base and bear cases too. In a typical market, a vertical move like this often invites a flush out. It wouldn't be unusual to see a sharp correction back down to the $75 level as big players take profits. But here's the difference this time. According to the USGS data, silver is now a strategic necessity. Every time the price dips, industrial buyers who have been caught short are likely to step in and buy that paper discount to secure physical metal. This means the old buy the rumor, sell the news cycle is being replaced by a buy the dip at any cost mentality. For your immediate watch list, you need to track 2 specific metrics. First, watch the CME first notice day for the upcoming contract. If we see a high percentage of traders standing for physical delivery rather than rolling their contracts over, the pressure on the COMEX will reach a breaking point. Second, keep a close eye on the gap between New York and Shanghai. If China stays 10% ahead of the West, the physical drain will continue, regardless of what the price on your screen says. The data tells us that the cheap silver era ended when that $80 barrier broke. Now, it's no longer about what the price is, it's about who actually has the metal in their possession when the music stops. The confirmation from the CME isn't just a milestone, it's a warning that the window for sub-$100 silver is closing faster than the models predicted. With the USGS officially reclassifying silver as a critical mineral and the Shanghai market leading the price discovery, the data is telling a story that the mainstream media is still trying to ignore. But now I want to hear from you. With silver hitting $83 and the US government shifting its policy, do you think the $100 dream is the real target for 2026, or are we heading for a massive cooling off period? Drop your thoughts in the comments below. I read as many as I can to see what the community is seeing on the ground. If this data-driven breakdown helped you navigate the noise today, make sure to hit the subscribe button and turn on notifications so you never miss a primary source update. This market is moving too fast to rely on old information, not financial advice.